Welcome to Banking 101, a first principle jargon-free course on banking. So far, we have learned about consumer and wholesale banking products. In this lesson, we will learn about asset management products offered by banks. Before we dig into asset management, let us orient ourselves on where we are in the course. We are currently learning about the four product categories within banking. We have covered consumer banking and wholesale banking, which together constitute 80% of global banking revenues. We will now move to capital markets products. These constitute a smaller share of banking revenues. However, they are more challenging to understand. And that is why we have set ourselves for success with our preparatory lessons on capital markets and trade life cycle. Asset management is the function of managing financial assets on behalf of others, on a professional basis, by a legal entity. What does managing mean? We can break managing assets into two subfunctions: investment management and asset servicing. Investment management products aim to preserve and grow capital through smart capital allocation. They ultimately answer the question, where should I invest? The purpose of asset servicing products is to facilitate the investment process and service the resulting asset positions. A stockbroker acting on her client's instructions is an example. Investment management products are growth-oriented, where the metric of success is investment returns tailored to the investor's risk appetite. Asset servicing is execution-oriented, focused on accuracy and cost. This brings us to the next question. Who manages assets? Individuals can manage their own assets. Think of a retail investor trading from his online brokerage account. Assets can also be managed by legal entities. In this lesson, we are interested in asset management by legal entities. We can categorize businesses that hold or manage financial assets into two groups. The first group own assets and the second group manages assets owned by others. Asset owners can be principals. The principals generate the savings being invested. Examples include investing arms of corporate entities and governments. The second category are principal intermediaries who collect funds in the form of deposits, pension contributions and insurance premia. They then invest these funds to generate returns. While they are intermediaries, they assume the ownership of the assets on their own books. They must meet their obligations to depositors, pensioners and policyholders regardless of what returns are generated from the investments. The third category are agent intermediaries who are acting on behalf of third parties and are not assuming the ownership of assets on their books. The risks are borne by the investors. Professional money managers and brokerage firms are examples. Asset management functions covered in this course refer to activities of agent intermediaries only. Since this is a Banking 101 course, we are interested primarily in the functions performed by the asset management divisions of banks, which correspond with the functions of agent intermediaries in general. Clients of the asset management industry include both principals and principal intermediaries. While many principals and principal intermediaries manage their own assets, they also outsource some of their assets to third parties. To understand asset management and asset servicing products, we need to unbundle the investment life cycle. First, a decision on where to invest is made. To take an example, a decision is made to invest in the shares of 100 large companies. In the second step, an investment package is formulated. To keep it simple, let us only consider two options. 1. A legal entity in the form of a mutual fund can be created to hold these 100 stocks. In this option, the investor holds units of the mutual fund in her brokerage account and it is the mutual fund which holds the stocks. Alternatively, the investor can hold these 100 stocks directly in her brokerage account. Next, trades are executed through a broker-dealer. 100 buy trades are made, one for each of the 100 stocks, in both the mutual fund and direct hold option. But in one option, the buying entity is a mutual fund legal entity, while in the second option, the buying entity is the investor. In the mutual fund option, there is an additional trade that involves the investor buying shares of the mutual fund. After the trade is executed, it is settled. Post-settlement, there is ongoing servicing of the ending positions, for example, posting dividend payments on the investor's account. Investment management products apply to steps 1 and 2. Asset servicing products related to steps 3, 4 and 5. Investment management products allocate investors' capital to assets, in accordance with an investing strategy, for the purpose of returns tailored to the risk appetite of the investors. We just said that the goal of investment management is to generate returns in alignment with risk appetite. Let us explore this concept further. In traditional investing, two broad metrics have been measured. Alpha measures the return on an investment compared with the market. An alpha of 0 means that the investment increases or decreases by the same level as the change in the overall market. A positive alpha is desirable. Beta measures how much you would expect an investment to go up and down compared to the market. A beta of 1.5 means that the investment is 50% more volatile than the market. A conservative investor may want to minimize beta. ESG investing refers to investing goals beyond just financial returns. It includes environmental, social, and governance goals. Before we proceed with learning about investment management, let us take a minute to understand who the industry players are. The industry is heterogeneous. To begin with, there are pure play professional money managers. Asset managers, private equity, hedge fund, and venture capital fall within this vast category. There are banks with asset management arms. There are specialist fintechs who focus on investment management. Finally, there are a large number of small financial advisors who cater to retail investors. These could be even one-person shops. We can further unbundle investment management into two separate subproducts. One is the advice. Second is the package that holds the assets that have been purchased as an outcome of the advice. Let us look at each one of them in turn. Advice gets delivered to the investor in different models. Discount brokerage firms are broker-dealers who focus on retail investors. When we trade through our online brokerage, we are acting on our own judgment. However, if someone is working with a human stockbroker, the broker may recommend a certain mutual fund or a stock. Full-service broker-dealers provide brokerage services to institutional investors like hedge funds and pension funds. They are often part of big investment banks like J.P. Morgan and Citibank. These firms have research arms that generate investment ideas for their clients, though it is the client's decision to trade or not. We will learn more about them in the lesson on investment banking. Fund managers advise funds like mutual funds, private equity, and hedge funds which pool investments of multiple investors. The portfolio manager for a fund is effectively an advisor to the fund, and her advice is embedded in the trades she is doing. Not everyone wants their funds to be pooled with others. They may want to invest in very specific ways. Hence, advisors can also serve individuals and institutional investors like pension funds. They can act on a non-discretionary basis, which means it is up to the client to heed their advice. They can also serve in a discretionary capacity, making trades on behalf of their clients in line with some broad criteria. To avoid confusion, let us distinguish between three roles. The advisor role relates to advising the client or a fund entity on investment decisions. Broker-dealers execute trades based on the instruction received from the investor or investor's advisor. The custodian role refers to holding assets on behalf of the investor. The same firm may offer both broker-dealer and custodian services through different divisions. Broker-dealer and custodian roles occur in the asset servicing side of the investing process. Let us begin with setting the stage with our characters. Mary is an investor. Mary's investment advisor is Bob, who invests Mary's assets on a discretionary basis. Bob uses a single brokerage firm for all his investing clients. Sam is an employee of the brokerage firm that also offers custodial services. Bob works on a discretionary basis for Mary. So, he periodically instructs Sam to transfer cash or securities out of Mary's custodial account as part of the delivery versus payment settlements that we had discussed in an earlier lesson. However, one day Bob gets into financial difficulties. So, he instructs the custodian to transfer securities or cash from Mary's accounts to his. However, Sam does not act on this instruction, as this is a one-sided transfer outside the context of a DVP settlement. This shows that even though Bob, as a financial advisor, is acting on a discretionary basis, he does not have custody of the assets. Since broker-dealers and custodian roles relate to asset servicing, we will cover them in the next lesson. In this lesson, we are focusing on investment management. The term assets under management is a commonly used term and refers to the total value of financial assets, including cash and securities, that are being invested. Discretionary basis means that the financial advisor has broad latitude making trades on behalf of her clients. Consider Alice, who has $1,000 to invest. So the AUM is $1,000. Her investment advisor is Bob, who invests Alice's funds on a discretionary basis. Bob decides to invest the funds in a mutual fund. Jack is the portfolio manager of the fund. Hence, he is the advisor to the fund. Through this example, we can see that the same AUM can have multiple advisors. Robo-advisors are algorithms that can recommend investment portfolios to individuals and automatically allocate their capital to various categories of equity and debt mutual funds. The input to a robo-advisor are parameters related to an individual's demographics like age and income, as well as their risk tolerance. The output is a recommended asset allocation. Now that we have covered advice, we will move on to investment package, a term that refers to the wrapper in which the invested assets are held. Investment packages are of two types. Separately managed accounts or SMAs are investment vehicles that contain the funds of only one investor. Retail mutual fund, private equity funds and venture capital funds are all pooled vehicles. The fund sponsor creates different types of funds and all investors have to buy into the investment mix of that fund. Pooled vehicles are more cost efficient to manage. However, an SMA can execute an investing strategy tailored to the risk appetite of an investor. An investment advisor may construct a portfolio of riskier assets for a young person and conservative assets for someone who has retired. An SMA for a pension fund may have more conservative assets than an SMA for a sovereign wealth fund. SMAs can customize investments not only to financial objectives but also environmental, social, and governance preferences of investors. For example, a Middle Eastern sovereign wealth fund and a European pension fund may feel differently about holding securities of fossil fuel companies. Pooled investment vehicles can be classified across multiple dimensions. One dimension is the type of investing strategy. In a passive strategy, the asset manager mimics an index. For example, a fund sponsor might simply create a fund that tracks the 100 largest companies in the country. In an active strategy, the fund sponsor is picking individual companies based on her judgment of its potential. The second dimension is the type of assets held by the vehicle, whether the assets are traded in public or private markets. The third dimension is the type of entity holding the assets. Exchange-traded funds and mutual funds are open to both institutional and retail investors. Hedge funds, private equity funds and venture capital funds, on the other hand, raise money from institutional investors and high net worth individuals. The fund sponsors typically sell directly to institutional investors and ultra-high net worth investors. In fact, some funds like hedge funds and private equity funds are not easily accessible to retail investors. For funds that open to retail investors, the fund sponsor may directly sell to a retail investor or through a distribution partner like a brokerage firm or a financial advisor. The payment of commissions by fund sponsors to retail distribution partners can create conflicts of interest where a financial advisor steers their investors' money to a fund that is not best suited for them. Regulations have been imposed in many countries to prevent this from happening. This brings us to the different revenue models in investment management. The largest chunk of revenues is earned through fees that are calculated as a percentage of assets under management. Fees for performance is earned on the gains delivered to investors. Less common are fixed fees models. Finally, an advisor may earn commission from a fund sponsor. However, such fees have declined over time given the conflict of interest inherent in an advisor steering an investor's money to a fund sponsor in exchange for commission. Within the context of asset management, we sometimes hear of two additional terms, namely wealth management and private banking. Let us next turn to understanding what these are. Wealth management products can be thought of as a collection of financial products that protect and grow the assets of high net worth individuals. Investment management products that we just reviewed are part of this collection. Wealth management also includes estate planning that helps high net worth individuals organize their assets and documents in a way that ensures assets are transferred smoothly to beneficiaries after their death. Asset protection involves creating mechanisms like offshore accounts and trust fund structures that protect assets in event of lawsuits and marital disputes. Tax management services organizes a client's assets in such a way that it minimizes their tax liability. Finally, wealth management includes a wide range of services that are unique to a situation. For instance, a wealth manager might advise a client who has inherited real estate or art. You may have heard of the term private banking. You can think of private banking as a concierge of financial products for high net worth individuals. Private banking could either reside within the consumer banking division or the asset management division of a bank. Private bankers orchestrate a bank's products to the customized needs of their high net worth client. These products could be core banking products. For example, a private banker can work with the mortgage department of the bank to offer her client a preferential rate jumbo mortgage. The private banker also facilitates the delivery of wealth management products to their clients. As in core banking products, a private banker can procure preferential access to their customers, for example, the opportunity to invest in a private company. While wealth management is a big part of private banking, it is broader in scope as it aims to be the one-stop shop for all of the client's financial needs, including core banking products. At this point, we have covered investment management products. We will now move on to asset servicing products. Given the vast catalog of asset servicing products, we will take a short break here and resume this discussion in the next lesson. Meanwhile, review the summing up section of this lesson. I will see you shortly. on the other side.